Powell said that the full effects of tightening have yet to be felt, and he reiterated that there are long and variable lags in their tightening decisions, which means raising rates. It takes a while for those to filter through the economy and for us to really see the effects of that. They left the interest rate, the Fed funds rate, unchanged, but they sounded very, very committed to winding down their balance sheet. That means that they are not going to be buying the majority of the debt that the government is going to try to be issuing here to fill up the coffers. Now, nearly all members think that it will be of the Fed FOMC committee think that it will be necessary to hike again this year. They predicted more of a soft landing for the economy. There's been lots of talk of recession, what could be coming. Their prediction in their SEP, the summary of economic projections, is that GDP for this year will be 1% and next year will be 1.1% for 2024. Now, keep in mind that the definition of a recession is 2 consecutive quarters back to back of negative GDP. So with 1% this year and 1.1% next year, it doesn't totally rule out a recession, but it does predict that if there is one, that it would be very short-lived, meaning less than a year. They also said that the labor market is getting better balanced and they expect more balance to come. Their predictions for unemployment, 4.1% unemployment expected by the end of this year and 4.5% by the end of 2024. They said again that it was a long way to get to their target of 2%, but they seem really, he says firmly committed, but I say, and it's probably not good English, but bulldoggedly committed to getting to that arbitrary target. So their predictions, the Fed's predictions for inflation for the next couple of years, CPI is projected to be 3.2% by the end of 2023, which is pretty consistent with what I said earlier in the week, 2.5% in 2024, and 2.1% by 2025. So that's where they're saying it's going to take a long time to get back to that 2% target. They are expecting core inflation to run higher than headline because core excludes food and energy, which are coming down faster than some of the other things. Rents is in that is what's driving that core and keeping inflation sticky. But we're going to have problems with that because of the real shortage that we have in available housing, and with mortgage rates being so high, it's keeping people from building. So, and then on top of all of that, you have the fact that he says credit availability remains uncertain. That's all about the banking industry, folks, and what's happening in the banking industry. As we've seen those failures of banks, there's probably more to come, especially if they do increase rates the rest of the year. And what they said was that they're pretty much predicting that that's going to have to happen to the tune of about 50 more basis points. Their median projection, so all of the members of the FOMC say, this is the dot plot thing that they talk about. They give what their projection is going to be for the Fed funds rate by the end of 2023. And it's 5.6%. So even though they see inflation coming down, they're still, even though they say they're data dependent and no decisions have been made going forward, they're still indicating and pretty well telegraphing more rate increases. So they say the Fed funds rate is predicted to be 4.6 by the end of 2024, so indicating those cuts not coming until next year, and 3.4% by the end of 2025. So I think they know that they've done all that they can with rate hikes, but they're still telegraphing that there's more to come just because they don't want, I guess, the markets to get overly exuberant